So our first question that came in from Paul via email, and Paul, I did see your question come in. I'm going to get to that as we go through your series of questions, is related to radioactive trading and the tools and power options. For those of you that are not familiar with radioactive trading, this is a trading strategy that focuses on limiting risk first using a properly structured married put position where I buy stock and I buy a put option. But rather than buying a cheap short-term put, we look to go further out in time to control the risk to single-digit percentages. So in the absolute worst case scenario, even if the stock fell 50% the day after I opened it, I'm guaranteed not to lose maybe more than 5, 6, or 7% of what I invested in the position. Now, after that structure is opened, there are 12 different adjustments, what we call income methods, that are used to lower the risk, generate income, and potentially bulletproof the trade. I say there's really 13 because sometimes I'll do nothing if I don't see an opportunity that matches the guidelines and the rules in the blueprint. And the blueprint is where this full technique is described, and you can see the special offer we have for the blueprint at radioactivetrading.com/iridium. Now, radioactive traders who use the Power Options suite of tools can find the initial positions in our married put search on Power Options that match the default criteria of what we look for in a new radioactive trade. And using the portfolio tools and Power Options, investors can track those positions and also see opportunities for rollouts or adjustments using the income methods, some of the income methods based on what's in the blueprint. Of course, the portfolio tools in the position analysis view that shows those adjustments also works if you're just tracking a covered call. It'll show you rollout opportunities for rolling up or rolling down your call. We'll do all the heavy math for you of calculating the new percent return, downside protection. If you're trading credit spreads, just long calls or long puts, even cash secured naked puts, the portfolio will give you ideas for adjustment and management techniques. But herein lies Paul's problem. Okay, now Paul's question is he opened a radioactive trade and he's tracking it in the Power Options portfolio. He bought to open 100 shares of 3M with a cost basis of $190.83. At the same time, following the guidelines, the blueprint, and the free webinars that we teach, just the initial structure, he bought in October 195 put at 12.03. Okay, this is the proper structure that gives us this limited risk. We use a far out in time instead of a close in time put, so the time decay doesn't work against us. Also, even though we're going slightly in the money and paying a higher premium, we see here the total debit for Paul's position is up around 202.86 with the stock trading around 190. Okay, well, why would you do that? Well, because you're guaranteed when you purchase the put to get 195 back. So the total risk on the position of the $202.86 per share investment is only $7.86, or 3.9%. So even if 3M dropped to $110 per share overnight for some unexpected reason, I could force someone to buy my shares of stock at 195. I only lose 3.9%, even though the stock's down 40% of its trading value. Okay, now, that's his structure. That's the starting point of his question. This is a trade that he's in following the radioactive trading techniques. Now, before we go into his three-tiered question, I'm going to go to Power Options. We're going to look at this position graphically, and again, just review quickly why this strategy is used. Okay, so let me navigate here over to Power Options. And I'm going to go into the portfolio tool right now where some of Paul's questions are related to. And you see here I have a married put on 3M and a covered call entered. And I'm going to use the more information buttons here in the portfolio to link to just the profit and loss chart at this time. Okay, so here's the structure of the trade. And here's what we have graphically. Looks like a long call, but remember, when you buy a long call, you're risking 100% of whatever you invest in the trade. I have a cost basis of $202.86 per share, which is my break even on the profit and loss chart. But remember, this break even is only at October expiration. if I held this position all the way to October, made no adjustments and accepted no dividends, then yes, I would need the stock to be trading at 202.86. But keep in mind, this put that I purchased at 1203, or that Paul purchased at 1203, does not go to zero. The minute I open this trade, I'm not down 3.9%. I'm not down $786. I'm not in need of the stock to move up 1203 to get to 2086 to realize a profit. All I'm losing is the bid-ask spread of this position. The minute I open this trade, I could have turned around and liquidated it, sold to close the put for 12, maybe sold to close the stock for 190.85. So all I really lost was the time value in the position plus or minus any gain on the stock. I'm sorry, not the time value, my apologies, the bid-ask spread. That's it. Okay? So when I open the position, I'm only lost at 3 or 5 cents. All right. So if the stock moves up, it's at 199.21 right now, but let's say the stock moves up to 200 next week, or by Monday, we'd have a $917 gain on the stock. We'd expect some loss on the put, but not nearly 1-to-1, so we're still at a profit on the position without the stock even trading at 202.86. Even if the stock was trading at 195, we'd probably still have a profit on this position. Because although the delta is negative, it's a small amount of negative value. Okay? All right, so this is the structure of the trade that we use where we're guaranteed to only risk single-digit percentages. And as I mentioned, just like it is here, Paul's tracking this position in the portfolio. Let's go back to the slides very quickly, because now we want to address Paul's dilemma. Paul had, remember, purchased the stock at 190.83, and he owns a 195 put. As we saw, 3M moved up to about 199.50. And Paul says, your system informed me that there are no trades, meaning there were no income methods following the rules in the blueprint that were consistent with your criteria. Okay, well, the first aspect we have to look at is you paid 190.83 for the stock. The stock is up above your put strike price, but it's only up 867 at the time, or 4.5%. So Paul didn't see any rollout opportunities in the portfolio. He decided to sell a call anyway. He sold a June 9th expiration 202.5 call for $1.17. Okay, now I pointed out here that the initial risk was 786. So he returned to the system for position analysis after he sold the call. The system responded with suggestions to roll the call. One of the choices was for the 200 strike. But the main questions, first, why did the Power Options tools not suggest writing calls? Okay, the stock was up, and it was above the strike, but it was only up 4.5%. When I logged in right now, it was showing it was only up 4.4% on the position. In general, when looking at the bullish income methods, which are 1, 3, 4, 6, 5, you could consider 12-1 as well, but we want to wait for the stock to move up 5%. Okay, so it wasn't triggered because the stock had only moved up 4.4, 4.5%. All right, why else did you not see the opportunity to sell a call? Well, I just realized there's a second reason, I think, or third reason. Well, your original at risk was 786. In addition to telling the blueprint how it tells you to set up the structure correctly from the beginning, which you did, Paul, the blueprint also discusses the rules of thumb and guidelines to maximize the value of using each of the 12 income methods. Then, of course, the 13th I mentioned is do nothing. As a general rule, income method number 1, simply selling a call against the married put, we have to have a few things in place. Number 1, we want the stock to move up at least 5% or to be trading above the put strike price. We also want to make sure that the premium we're generating represents at least 1/3 to 1/2 of the initial at risk. Your risk was 786. We would need a premium of at least 260 for an out-of-the-money call to have appeared in the rollout opportunities. You sold a call for $1.17. It's $1.17 you didn't have the other day. But at the same time, the general rules in the blueprint dictate that we want to create at least a third of the premium to reduce the risk by at least 1/3 of the initial starting point, or whatever the risk was at the time, to see that particular income method in the rollout opportunities. I'm not sure of the exact time frame. I believe it's probably within the range, but also you don't want to go more than 45 days out with a call. June 9th is probably within, that 34, 35-day time period, which is okay. But in general, we wouldn't go beyond that. So if you sold the June 19th or 20th, the standard expiration, well, it probably wouldn't have shown up anyway if it was more than 45 days out in time. Okay, so it's not just sell a call whenever the stock is up. It's not just sell a call for any premium. To maximize the value of the income methods that are used are outlined in the blueprint. We want to make sure that we're receiving at least a third of our initial at risk. When we use income method number 1, selling a call, we want the stock to be at least up 5%. And we don't want to go more than 40 or so days out in time. We want to keep it in the shorter time frame to follow the 3 core principles of radioactive trading. Okay, now let's move on to a different structure. He sold the call now. That's why the calls didn't appear. But let's move on to now he sold the call. After he sold a call against the position, the system reports large decreases in break-even. I don't understand how it's possible if your system reported a decrease in break-even of $6 or more in response for the sale of a $1 call. How do you calculate the break-even? All right, well, I got to go back to the profit and loss chart, and this will apply to other strategies you might be using, such as diagonal or horizontal calendar spreads. Anytime you have 2 different expirations you're evaluating on a profit and loss chart, to answer his question is why his break-even moved. Okay, so let's go back to Power Options and our profit and loss chart for the 3M married put position. Okay, so here we are, one of our tools here, the profit and loss chart, or what's called the custom spread tool. We've got Paul's married put entered. Structure of the trade, and we see here we've got the married put. We know we have a controlled risk, but we also already showed that this 202.86, which is the current break-even, is only relevant at October expiration. Okay, my break-even when I opened this trade was probably 10 or 15 cents up in price at 191. Okay, so what happens if the stock moves to 191 in the first day after I entered this trade? Well, I've got a 17-cent gain in the stock, and my October put probably dropped down to 11.99. So I gain 17 cents on the stock, maybe lose 9 cents on the put. I'm still up 8 cents. So the break-even one day out is only 10 cents above, 20 cents above the current stock price. This break-even is at October expiration. This is how any profit and loss chart at your broker, any other tools that you use, okay, any graphing tools that you use, yeah, again, if I did nothing, accepted no dividends, made no adjustments, I would need the stock to be trading at 202.86 in order to break even. That's not my plan, and I never hold one of these positions all the way to expiration except in circumstances of my own greed. All right, so what did we do? Paul sold. And there's nothing wrong with what you did here, Paul. You sold the June 9th, 35 days out. Okay, so the June 16th might have fallen into that 45-day time frame as well, but anything after that wouldn't. So with income method number 1, you want to keep it under 45 days. So you went out to June 9th, and you sold the 202.50 call for a premium of 117. Now remember, our break-even was at 202.86. Paul's concern is he just generated $1 worth of premium, and my break-even now is at 193.66. How did my break-even drop down 6 points, as Paul mentioned? Okay, a little more than that, actually. It's 9 points here by only generating $1 in premium. Because this is looking at the expiration of June 9th, not October. Yes, your cost basis is lowered down to 201.69. So you'd say that should be my break-even. But you're dealing with time. Part of the 3 core principles of radioactive trading in any trade. You sold short term, you own long term, which decays in value much more slowly. So where is this break even coming from? The same way any options chart would calculate any type of time spread, where you have options that are further out in time and options closer in time. Okay? It's looking at June expiration. So where is this coming from? This is taking into account where the stock price would need to be for the position of break even based on what is the theoretical Black-Scholes value of your long put at June expiration. So this is telling you that if the stock was trading at 193, yes, you still have a cost basis of 201.69 on the position. Okay, that's true. But at 193, you're saying, well, wait a minute, I have a loss on this position, 193.66, excuse me. You have a loss on this position of $8. I only generated $1 in premium. How is that possible? Well, let's say the stock fell to 193. Your call expires worthless. You know that. You could sell to close the stock at 193, and your put is still going to have $8 worth of value, right? You're holding the 195. It's $2 intrinsic, but from June to October, you still have 4.5 months of time premium because you sold the 9th. Okay, so about 4.5 months of time premium. So that'd be priced near at $8, and you'd be at break even. This is not at October. It's not based on the cost basis. It's based on a shorter term value because that's what you sold. It's looking at the June expiration. How can you test that? Well, when you're looking at the profit and loss chart, Paul, and you don't agree with the number, plug it in down here into the calculate expected profit and loss value, select June 9th. So if my stock was trading at 193.66, what do I have? I have a gain of 283 on your stock, right? You purchased it at 190.83. It's at 193.66. You've got a gain of 283 on your stock. Your put's going to lose, but it's still going to be worth $800, and you generated $117 worth against it. I agree. This is theoretical. It's using the Black-Scholes pricing model. It's not etched in stone, but this is what we'd expect the put to be worth. Think about it. You've got an October 195 put on June 9th when the stock's trading at 193.66. It's got $2.34 of time premium, of intrinsic value, and 4 months of time premium. I'd think that'd be worth $800. Yeah. Okay. So that's your break even, Paul. Why did it lower? It's because you're looking at June expiration now, not October. And this is how every system, if you go to Interactive Brokers, Thinkorswim, any options platform, brokerage house or anything, even Fidelity, you would see the same type of adjustment because it's always looking at the nearest term expiration, not October. Because I'm not focused on October, I'm focused on June. This is where I need to do management now. This is where I need to adjust on the position. Okay? All right. So let me clear this out now, clear our call out that we've answered that part, go back to the standard married put, and very quickly I'm going to go back to the slides one more time to address one final question that came in from Paul. Okay? So that was question number 2. How do you calculate break even? Well, it's a shorter term expiration now using the Black-Scholes pricing model. All right. So following that, he says, I need advice on rolling puts as another potential adjustment. In this case, your system did not suggest rolling puts even though your stock was above the put strike price. What is the best way to roll puts? Again, it was because the trigger wasn't there. On a bullish income method, it looks for the stock to be 5% movement from your original purchase price. You're still hovering around 4.4. Okay? And also, there's other guidelines for income method number 4 that are in the blueprint that dictate when and how you would use it. Okay, so what we call income method number 4 is rolling up the put. We've shown this in other webinars. I have no problem showing it today. When the stock does go above my put strike price, in addition to maybe selling a call, what I'll look to do is also adjust the put, but I'll usually do that first. Why would I adjust the put option? Okay, whoop. There we go. Sorry, folks. Well, let's go back to our position and see why. Now remember, one thing I didn't look at, and I'm going to do it, I have to do it again. I should have left it there, and I apologize. When Paul did sell this call for 117, the 202.50 for June 9th, okay? He lowered the risk down to 3.3%, capped a max profit at 2.5% on June 9th at the stop, happened to be trading right at 202.50. Okay, so we reduced the risk by 0.6% by selling the call. Now, put is above, stock is above, our put strike price. And another way to reduce risk is to take advantage of the change in the put price and roll it up to a higher strike. How is that an advantage? Well, think about it this way. When Paul got into this position, the stock was trading, let's call it at 191, just to make the math simple. He paid $12 for a 195 put. 5 of it was intrinsic, $7 was time value. Okay, that was the total 12. Okay, $4, I'm sorry, it's $4 and $8. If the stock's at 191, his 195 put is $4 intrinsic, $8 in time premium for a total value of 12. Okay, so that was the original risk, wasn't it? About $789, I think. That's the 800. That's the time value. That's the only risk on the position is the time value of the in-the-money put you're buying. Okay, so go to October, and wow, we've lost 50%, $6 on the put option. A little bit less than $6 on the put option, about $5.70. Okay, but in order for that to happen, the stock had to move up $9.50. Okay, so that's close to what I'd expect. I still expect to see about a 45 to upwards as much as 65% gain on the stock position, even with the put in place with this technique. But what's unique now? Remember, well, this one isn't as great, which is probably why it didn't show up, Paul, other than the fact that it didn't move up 5%. You originally paid $12 for the put, 4 intrinsic, 8 time premium. Okay, now we see here what has happened. The puts dropped to 640, but it is all time value. Okay, the whole value of that put is time value. So you really only lost $1.60 in time premium. Okay, most of the time we actually see this swell when it's at the money. I might show an example of that in a moment. But I can still take advantage of this. Okay, so let me go ahead and do that. I would look to, sorry folks, there we go. I'm going to add it back in. And I'm going to sell to close the put at 630. Okay, so what does that do? Well, that's going to reduce my cost basis down to 196.56, but now I have no protection. But now, staying in October, I could buy a 200 put for about 850, going with the mid price here, 835 to 865, going mid price at 850. Oops, sorry folks, 850. All right. Now, what did I just do? I paid a debit of 220 to gain 5 points. So this reduced my risk even more than selling the call. I took it from 3.9% down to 2.5%. Now, it does increase the cost basis on the position. Okay, I did pay a debit, but I did that to reduce the risk further, and I left the upside open. Okay, this one might not have appeared anyway because there are other rules for income method number 4 discussed in the blueprint. Now, one of the rules I know is satisfied, and that's what I call the debit to strike difference ratio. I want the debit of 2, in this case was 220, my apologies, divided by the difference in strike price, I'm gaining 5. I want that ratio to be less than 0.6. In this case, it's less than 0.5, which is fantastic. But I typically also want to see a reduction in risk of 50% when using income method number 4. Okay, and this doesn't quite get it. My original risk was 3.9%. I would have wanted this to drop down to about 1.9 to 2.5. It's still a little bit high. Okay, but that's what's in the blueprint, is the other rules and guidelines as to how and when to use these income methods. And if you don't see one of those there, then it's probably because it just didn't match that criteria, okay? All right, so I'm scrolling through a few of the other questions here. I've got other questions I got to get to real quick. Okay, David asked a different question. Okay, David. David's is a little bit more involved with this technique. What David is asking is, he knows about the 60% ratio I just mentioned in regards to income method number 4, but he says, what is an acceptable ratio to use if, let's say, this was a June option and I decided to roll it up, but I wanted to add more time and roll out to October where you're paying into more time? You're not going to get the ratio of 0.6 in that scenario. What I would do, I have a number for it that I usually use, but I would go less than 0.8 to do it that way. In that case, try to keep it less than that as well, and look for it in that scenario, David. But also keep in mind this: if I'm rolling from June to October, I'd be going out 4 more months out in time. And I tried to keep the additional risk I'm adding by going further out to be around 1% per month if possible. So if I had a 4% risk right now with an expiration coming up to June, I wanted to add more time. If I'm adding 4 months, I wouldn't want the risk to go up more than 4% to be at an 8% risk for the out to October trade. Okay, so those are just generally ideas. Okay. Okay, 1 second. Okay, David, this is a question that I'm going to answer. It's related to radioactive trading, so I'm safe with David's, but I've got Anthony's question on deck. I've got another question on deck that came in earlier that I really want to get to. But this is in relating to this technique as well. So what do we know here? With this position, when it was originally entered, the put here was only about maybe 2.5%, maybe 3% in the money when it was bought at 195. David's question is related to, with the percent risk of the trade in the portfolio with acceptable limits, would you prefer the trade where the put is only 5% in the money versus 10%? Well, that comes down to your risk tolerance. Both would be acceptable. Okay, if I went further in the money and still had a controlled risk, or if I went further out of the, to higher strike prices and still at a single-digit risk, both are acceptable, but it's based on where your target price is for the stock and what you think is going to happen. Okay, where am I going with that? Let me show you an example. I'm just going to pick a random trade from the search results. TAL, no? Yeah, I'll stick with TAL Education. Right now the stock's at 120.20, and I'm showing I could buy a November 125 put for $14. This puts my risk at 6.9%, and yeah, I'm, short amount in the money of only about 2 or 3%. Okay, so let's go to our analysis tools. I'm going to go to the search by symbol tool on TAL for November. See, here's the other strikes. If I bought the 120 right now, I might not need the stock to move up to 125, and I could sell a 120 call or maybe a 122.5, but I'm increasing my risk to 8.8%. The 130 strike, 10 points in the money, offers a lower risk, but I would only open this one if I really felt the stock was going to move and was going to be trading at or near 130 in the first 30 days. The 135, it's still within a reasonable range of target, under 15% or 20% or so, and it carries a low risk of 4.3%. But see, even with, if I went with the 135, even with the 5% increase in the stock price going up to 126, okay, if I got a 5% increase in the stock price in the first 30 days, I'm not going to be able to do a lot of adjustments with this deeper in the money put. I need the stock to go up to maybe 131 or 132 before I could get a good near-term premium on this 135 call. And why don't I want to sell a call below the put strike price? Because remember, my cost basis is 141. If I sell the 125 call right now and only generate $2 worth of premium, if the stock gaps up to 138, I still have a cost basis of 140, but I capped my upside at 125, so I might have a $13 loss because I sold the call too soon and at a wrong strike price. So which one is better? Well, it depends on your risk threshold for the position, and it depends on your target for the stock. I have some webinars on this, David, where I talk about sort of the three bears. Now, all of these sort of match my criteria. The 8.8% doesn't. I like to keep it under 7.5%. But all of these three match my criteria. Normally, I sort of go with the three bears. Not too hot, not too cold, not too soft, not too hard, right in the middle, and I'd be tempted to the 130 on TAL at 5.7%. But if I looked at the chart and thought it was a slow mover, but it still had potential for growth, I may be tempted to use the 125 because I'd be more able to apply income methods faster at the 125 strike as opposed to the deeper in the monies. Okay, so which is the best one? Depends on your risk, what you're comfortable with, and what your target price is for the stock after you do your other research. Take a look at the stock chart, company information, news, and profile. If I think 130 is a good target, I would use the 5.7 strike. What do I mean by a good target? Well, based on how I analyze stock, it would be based on what I feel is a decent target price for the stock in the next 20 to 40 days, 30 days, somewhere in that time frame. And if I feel the stock has the strong potential to reach 130, I'd be okay. Would I be better using the 125 if it only moved up to 124, 126? Yeah, I get better premiums and I could reduce that faster, but I'm also taking 1.2 higher risk over the entire time. Okay, so that's also discussed in the blueprint about the strike selection and more. All right, so again, going back to just the married put view, what we talked about with Paul today is not only ideas on how to use the income methods. We talked about income method number 1, the 12 different income methods that are discussed in the blueprint, but also why they didn't show up in a portfolio. Okay, and most of the triggers because it didn't match the other rules of reducing the risk by at least a third, and it hadn't moved up by at least 5%. Now, what would it look like if something appeared? Here's a covered call that we simulated. What if I got into 3M around May 1st at 190.83 and sold the 195 call at that time for 90 cents? Well, now the stock's at 199.40, so I'm in a different scenario. I expected a return of maybe 2.5%, 3%. But if I want to stay in the stock for further upside, I have to roll the call. Anytime you're tracking in a position in the portfolio, whether it's a covered call, a naked put, even just a long call, you can go to position actions and position analysis. This gives us a breakdown of our current position, shows you what your current liquidation value is. Well, it's expiration today, so it would have been that. And, you know, my max return on the position. And then down below, you see rollout opportunities. So this is showing me that I could buy to close my call for $4.50 that I took in 90 cents for, and I could sell to open 2 week out, May 26, 2025 call for 56 cents. Now this is rolled at a debit, but my return goes up from 2.7 to 4.5%. So if that matches my trading plan, you know, for a 21-day period, I'm happy with an increase of 1.8% on this position, then I might roll to that strike. Or I could get a less of a return, but go out to the lower strike 200 for June and increase my return by 1%. Okay, and if none of these match my trading plan, guess what? I'm staying in this position and I'm allowing myself to get assigned at 2.7% for 8 days. It would have been 14 days, but I'm taking that return because this doesn't, getting 1.8%, if my goal is to make 0.8% every 7 days because I'm trading weeklies, well, I'd need this to be a 2.4% increase to match my trading plan. So that's not it. It's only 1.8% from where I am right now. And none of these match it either. I see some here, but I've got to go out to June, and it's the 205 strike at 5.7%, meaning I need more intrinsic gain. I have only an 18% probability. So again, if it doesn't match my trading plan, I'm not going to roll for the sake of rolling. I may just take assignment and then reevaluate the position later on. Another feature is you're evaluating these rollout opportunities that come up. instead of seeing things numerically, which is always good, let's be honest, everyone likes to see it graphically. I'll take that income method rollout opportunity idea, use the more information button, and go to simulate trade. Now I have a side-by-side comparison of my original position and where I stand right now on the left in red, and what my new position would look like if I made this adjustment and rolled the call up, including my new cost basis, my new potential percent if assigned, the monetary gain as well. And if I wanted to, oops, sorry folks, if I wanted to, because this is expiring today, I could go ahead and make this change to my portfolio right down here at the bottom. So there's my rolls. I'm only getting 56 cents, but going up to 4.5%, my apologies. So I'm going to submit change to portfolio here at the bottom, back in the portfolio, but now I've got the 26 May 202.5 call at 56 cents. Okay. What happened to the other call I sold? Why is it not tracking? Well, it's a closed position. It's available in the analysis view and in the transactions. The portfolio only shows you open positions. Okay, but again, why are we not seeing rollout opportunities here for 3M? It's because the adjustments don't match the rules in the background, what's taught in the blueprint of what you would look for to properly use income method number 1 or to properly use income method number 4. And again, that's one of the advantages of owning the blueprint if you're serious about implementing radioactive trading. It's not only the proper setup of the married put from the beginning, what we answered with David about the strike selection, but also how and when to use these 12 different income methods, how you can use them incorrectly and actually get yourself in a lot of trouble as well. Okay, that's why the blueprint's important. You're not going to get a lot of the information, all the information you need just from the free webinars, although I do give away a lot of information. But full technique is only there. All right, that's for Paul's questions. Now, Donald, you've been patient. Do you want to talk about backtesting a covered call strategy on SPY? In the PowerOptions tools, in addition to offering patented tools in over 23 of the commonly used strategies, I didn't have covered call selected, so I go into the other strategies tab. Let me get long puts out of here and that as well, and let me go ahead and add in covered calls from our available menu. Let me save that configuration. All right, so we looked at one with the married put originally, but in the covered call menu, we offer tools for the picks of the day, weekly picks of the day, the search tool where you can create your own personal screen, and a search by symbol tool so I can see covered calls just one strike at a time, or one stock at a time. Now, Donald wants to know, we also offer is backtesting. During a trial, if you're just on a 14-day free trial, you have access to 3 months of historical data for all of the options on every trading day using just the closing prices. But if you subscribe to the upper level of service that offers the historical, either the historical on top of the 20 minutes later, the full service, which includes real-time and the historical tools, you'll receive historical data back to April of 2006. Why that date? Well, that's when we started recording it ourselves rather than trying to buy historical data and distribute it to you guys. We're recording our own. Okay, and all the information at the close, deltas, applied volatilities, Black-Scholes values, everything is just being recorded on a daily basis in the background. Terabytes and terabytes of options and stock data every day. Okay, well, not every day, but we've enhanced it. It's ballooned to terabytes and terabytes of data. All right, so Donald, you could use the search by symbol tool. So I'd go to covered call, I'd go to backtest, and I'll go search by symbol. And let's see, I want to go back to March, and I'm going to look at the first break, Donald. 6, 7, 8, 9, 10, 13. Okay, so this was the first week. Okay, so Monday would have been the 6th. That's far back as we go for a trial, only 3 months. And if I'm searching on the 6th, I could choose all weeklies, or I could look at the standard March expiration. And then you can toggle between less, more, and all results. I'll use less. And we'll just type in SPY. Now, here are the 6 covered calls that appeared based on some hidden criteria because I selected less results. I have the at-the-money expirations for the 15th of March, 9 days out, the 17th of March, standard expiration 11 days out, and the 31st of March. Now, The stock was at 237.71. We see different returns, all of around 0.5, 0.6%. Just seeing that alone, I probably would have stuck with the 9-day out. Why go 11 days out or 25 days out for the same return if assigned? Might as well just stick with the 9-day out trade. Okay. But how would these all turn out? I can hit calculate group results. And what that's going to do now, Donald, is it's going to show me how each of these turned out. So some of them didn't hit full return. Okay, it took it to expiration for each one. 315 for the March 15s, 317 for the standard, and so on. Oh, these are some of those Wednesday series. That's what threw me off. I'm sorry, the March 15th were not a weekly. They were that Wednesday, Monday series thing that's available now. Okay, and they did show the greatest return. On March 17th, the stock pulled back, right? So we went up to 238.95. On the 15th, you would have been assigned and done well, but then it pulled back. So you still would have had a gain on these, but lower. But honestly, that's just a quick way to do it, Donald. But I think you have a different idea, okay? And what I'm going to do is go back now. Let me close that out. I'm going to go back to back test, and I'm going to go into the Smart History. Now, what the Smart History allows you to do is to screen for positions based on any searches you've already created or any of the default ones. So I could go weekly picks of the day for March 6th, and these are the trades that would have appeared on March 6th had I opened up Power Options, gone into Covered Call and run a search, and selected the default weekly picks of the day screen. I apologize, it's taking some time. It's because between 4:45 to 5:30 p.m., the historical data is updating in the background. So I'm interacting with a tool that's getting a lot of data dumped into it right now. I'm dealing with a file, a system, a program that's getting a lot of data dumped into it right now, okay? But here I could calculate the group results and see how these turned out to track a selection criteria. But you've got something different. You want to do covered calls on SPY. And of course, I don't know if you want to do weeklies or standard, and it doesn't matter. Let's say you wanted to look at a historical record of weekly SPY calls that were less than 7 days out in time and had a premium of at least 50 cents. I am not even going to bother with volume and open interest because the weekly is going to have so much liquidity, it's ridiculous. You're not going to have to worry about that. And maybe you wanted at least a 0.5% return. Okay, so here's what I'm going to do. Even though I'm in the history, I'm going to hit Clear Filters. I'm going to select all expirations. I'm going to set my time frame to be between 2 to 7 days to look for weeklies. I want a downside protection of maybe at least 0.4 and a percent if assigned of at least 0.5 on SPY, minimum. And I said, what did I say, an option bid price of 25 cents? Maybe it's 40. Maybe we want 45 cents. Okay, let's try that. Okay, I'm not going to worry about volume or open interest. You don't have to worry about technicals or fundamentals, okay, because you're looking at SPY. Now, the best way to do this is you could do this in the search, just create a dry search with your 2 or 3 criteria. Go to lists. And under lists, you can create and modify stock lists. Okay, so I've got different ones. I have a list I always show that I combine lists. I combine the leveraged ETFs and the inverse ETFs to remove from my stock covered call naked put screens because I don't want to take the chance with a 3 times ETF or an inverse ETF. I remove those from my list. But here's one that's my index list. It only has 4 symbols in it. Guess what they are? RUT, SPX, NDX, and I forgot what the 4th one would be. But there's only the 4 main indexes. That's all that list is, just if I wanted to screen against them. Oh, and standard ETFs, by the way. This is a list I created on my personal account. This is a trial account, but I created it there. And it's just SPY, QQQ, and IWM. Let's remove QQQ and IWM. Okay, so now I've just have a list of SPY. Now, how would you do that? You'd click Create List when you go into this list field and just call it SPY, put in your symbol, SPY, and create. Now, across all strategies, you can choose to screen any criterion, bull puts, bear calls, iron condors, and go into the lists field now, and close that window. Go into that list field now and select that list. Okay? So it's just refreshing the page for me now. My other criteria is still there, but let me go back in a list. It reloaded it. And it was the standard ETFs list, right? It was just SPY. Now let me submit this. This is my own search. Oh, okay, we've got a problem here. And I know it's not the time frame. I think it's this. So I've got to lower this. Maybe I'm going to lower this, all right? Because I'm using weekly, so I shouldn't be looking for too much return. You're going to be difficult. I'll go back to 25, okay? I'm not going to spend too much time with this. Oh. Yeah, it's easier to find there. Okay. Let me do this. Let me save my search. Even though I'm here, I can save this search. Call it SPY Covered Call. I have caps lock on. Darn it. Okay. There we go. Okay, SPY Covered Calls. Let me go to the next day. Can't be that. All right. I'm just going to drop everything down again. It's probably just expecting too much here out of SPY. My apologies. Yeah, here we go. Okay. Yep, 0.3. Downside protection. It was too high. And the percent if assigned is right at the mark. Okay, so if you're doing weeklies, you've got to accept that, number one. But here you go. So here's this structure. We have the two at-the-money covered calls, and you could fine-tune this further, but you could create the search in the main searcher here, and then go into the back test and start running the search. So I'd run it to March 10th, calculate group results, and we saw that we'd have that return of probably 0.3 and 0.2 for the first cycle to March 10th. Excuse me, I get a drink of water there. Okay. Now what do I have to do? Well, now I got to go back. Okay. It's a little bit manual, I know. Now I've got to go back and say, okay, well, I'm going to keep the same search. I know I made 0.3% for that. March 10th was the expiration. What if I ran the search on March 13th? For the covered calls on SPY that match my criteria. Sorry, folks. Forgot to select the search again. It's all right. Why wouldn't I do it Friday? Because I waited till Friday to expiration to get assigned, and I'd likely make the new trades on Monday, March 13th. All right, and here we go. Sorry, it's interacting with the data once more. And all the data is downloading, okay? Okay. All right, so there's nothing for that week that has the return that we want and the net credit for March 10th going forward to the, or March 13th going forward to the 17th. Oh, I saved it wrong. My apologies. I apologize for that. I didn't save it with the new criteria. So now if I submit it, we'll see the results, and you keep doing it that way. Okay, so that's how you can use the search tool. It's a little bit manual, but for what you're looking at one stock at a time, either in the covered call search or in the backtest smart history, I'd create your own search with just the basic criteria you want for your time frame, your downside protection, percent if assigned, minimum bid price. That's really all you need. You don't need any other stock criteria because you're just looking at SPY. Create your list, and once you have it, save the list. And then you can start running the screens for each expiration cycle against your position. Now, all that being said, there is another feature that might be faster for you. Okay, I'm going to go into the store here. Okay, the Power Store. You access it right underneath the Home tab. There's a feature here called Strategy Testing and Optimization. For $50, we offer a service where see how your search criteria and trading plan are performing. So what we do is we'll take a saved search that you've set up with your criteria if you just want to look at a stock, and we can go back, to 2006 or 8 years or so. And what we'll do is analyze sort of, look at your history and how they would have performed. You can even give us ideas on exit criteria. If the stock moved up or moved down 5%, you would have looked to close it or things of that nature. Implemented in the positions are closed or when they expire, we can implement that as well. So we can do a one-time test for your criteria so you can see how it would have performed for $50 back in time with your exits in place. I'm going to add it to the cart right now because I just want to mention something here. See if it goes through. Okay, it didn't give me the, I want to go here. I'm sorry. Click that. The ones that are available right now are covered call strategy, naked puts, bear call credits, bull puts, buying calls, buying puts, long stock, and we're doing long straddles as well. Soon we'll have strangles, and I think we're moving on to calendars with this idea. So if you have a search criteria in one of those strategies, you want to know how it would have performed, and you can give us exit triggers of stock change up and down, option change up and down. We'll run this ourselves in the background so you don't have to do it, and we'll tell you what your end results were for that, and that's $50. Now for a little bit more, okay, $500, what Ernie will do is take your search criteria and your trigger rules, he'll run the test, and then he'll spend time analyzing the performance, making changes to the criteria, running other tests, and improve your search results and the exit strategies based on what he's been doing in the background for different testing for different strategies. By the way, this feature, this structure we're talking about here is what he used to develop those picks of the day that were back tested. Okay, so that's how we use the historical tools to do it manually. In the back test, you could do the search by symbol, or you could use the Smart History Excel. But if you've got a list, a strategy in PowerOptions that you've created, a search that you've created, and you've got some exit strategies for $50, you can tell us what search you want to use, what exit strategies you'd want. We'll work with you with that. We'll run the test, tell you what your results were, and for a little bit more extra, Ernie promises a 20% improvement on whatever your trading results were using different tweaks to the exit strategies and the search criteria that are available, and that was for $500. Okay. Andrew, I'm sorry, I thought it was Anthony, it's Andrew, my apologies. I need negative delta. How do I search for declining stocks? Okay, you can do it in any strategy. I'm going to keep it simple, and I already took out long put. Let's use bear call credit, okay? And I'm going to go into the search. Now, declining stocks, what are they? We had a discussion on this last week a little bit. We talked about some decreasing stocks and what criteria one might use, and that's perfectly fine. There's nothing in the fundamentals I would basically use. I don't try to cap market cap or price to sales or price to book as a negative. Could look at price to earnings, earnings per share growth of less than 0. That's going to reflect poor management. In general, we're focusing on the technicals. Okay. What is the most basic one I'd look for, of course, for a declining stock? I'd want a stock that's trading probably below its 20-day or its 50-day moving average. Okay, so we look for stocks that are trading below the 20-day or 50-day moving average. I'm sorry, let me clear the filters out. All right, so here in the technical, simple moving average, a stock that's been declining in price. Okay. What else happens when a stock is depressed and declining in price? Well, most likely, the MACD line is crossed over to the negative within the past few days or more. So what I might look for is where the MACD has crossed the signal line, at least in the last 1 or 2 days. So I'll just do 1 day. When MACD is below the signal line, at least 1 day. Now, in addition to that, I might use some Bollinger Bands as well, but I'm going to hold off on that, Andrew, for a moment. I'm going to go into the options here. Again, I'm going to put in 2 to 8 days, so I'm just looking for next week's expiration. I want a net credit of, 50 cents for a strike difference equal to 5. I'm putting in these criteria not as a recommendation at all, but just to narrow down the universe of options. And I want a probability of at least 80% that it'll expire worthless. Please submit. Yeah, I'm in bear calls. Okay, so let me go ahead and submit that. Oh, that's so mean. All right, drop this down to 40. Wow. Someone needs to remind me that I'm looking for 50 cents on a 5-point spread, that I should only be looking at, all right, I'll go greater than or equal to 2. That was a 30-day trade I put in, looking for 50 cents on a 5-point spread. I'd see that 30 days out, not 3 days out or 5 days out. Okay, so net credit, 25 cents. Let's make it 15 cents. I'll put 10. Make it worth a while. Still with 80% probability. Maybe I have to lower that to 75. Nope. Okay, here's an important rule. I'm looking for bear call spreads. I've got some companies that are likely declined. I got more for you, Andrew, so one moment, bear with me. But I've got, again, these 3 times bull bear ETFs. There's an inverse ETF in there as well. I don't want it. Those things move too rapidly for me. nugget. I know you all have your opinions on gold. We all do, gold and silver. Well, if it reverses and jumps up tomorrow, the bull 3 times ETF could gain 5 or 6 points. Be in trouble on my spread. So I'm going to avoid that. I'm going to go into lists again. Anytime I do a credit spread, I'm going to select that ETFs to remove. I don't want to see the inverse or the leveraged. Get them out. Okay. Disney, standard ETF, the Treasury market's in there too. United Rentals. Okay, so different strikes based on the criteria I set in, but let's talk about something for a minute. I'm going to go to the charts. I'm going to go to big charts. Typically how Ernie and I set up our positions is, our charts, is we look at the Bollinger Bands here. Okay, so an upper and Bollinger Band. If I've got a stock hitting the upper Bollinger Band, or what's known as in the 90 to above percentile of the what's called the percent BB20, that usually tells me a stock that's been increasing and growing and is hitting up at the top of the Bollinger Band. But if I have a Bollinger Band of 10, that means the stock's been trading or is just at 10 or lower, the percent BB20 is what we call it, then it's been moving down and it's triggering or dropped below the lower Bollinger Band. So that's another one I'll look for. Just had a MACD crossover within the last few days, and the RSI went negative too. But you see, that's probably earnings related, and now it's coming back up. But here's what I'm going to look at based on this chart. I'm going to look for stocks that are under, let's say, less than 15% of the Bollinger Band 20, the BB20. So it's been riding or it's been close to this lower band. It has to be below the SMA 20. Okay? And again, I want that recent crossover. I'm going to find someone that are related to earnings, but I'm going to find others as well. Okay, so let's go back. Now that I've explained what the 3 I'm looking at, I'm going to go back into technicals. We've got the stock below the SMA 20. I've got that it's crossed below at least 1 day, although that might be earnings. So let's increase it to at least 2 days. Okay. Now I can also select to look for a longer-term downtrend. That was a hiccup, wasn't it, Andrew, because of earnings? So stocks where it's crossed under the SMA 20 to be at least 3 days. I'm going to push that a little bit more. Okay. And again, at the end, percent BB20, that Bollinger Band I talked about, we want the stocks at the bottom. I'm going to look for it to be at less than 15. Okay, so 100 would be right at the top, on the top Bollinger Band. 0 would be at the bottom. We're going to force us to find stocks that are less than 15 with our other basic spread criteria. We do see Walt Disney, GLD as well. Okay, so let's take a look at the chart for GLD. All right, so it's been trending downward, and it's sort of, you might say it's bottomed out, but it's been in a recent decline. Okay, so from up here down, we've just crossed it. You know, maybe I want to do something a little bit different. Maybe I want to be a little bit tighter, Andrew. And what I mean by tighter is instead of forcing it to be 3 days below the SMA 20, let's open it up to be only 1 day. So it's just crossed below the SMA 20, and the MACD is crossed below by at least 2 days. And I'll put this at 20 for now. So it might see ones that are looking like they're starting a downtrend. Will we get anything besides Disney and GLD? No, unfortunately we didn't. I don't think that's because of the criteria here, but let's find out. Let me lower this to 70. And there we go. Okay, Celgene, interesting one. We'll see what that would look like. Okay. Now, yeah, see, it has broken. It just went to the lower band, broke below its 20-day moving average, just had the crossover within the last few days. So it's contracting. What I'd be careful with this one is see when earnings are, okay, because that's been condensing. So let's see when earnings are, because that might be something coming up. So let's go to research, stock research. Oh, okay, 727. So we're in the clear there. We just probably recently had earnings on CAG. Okay, so that's what I'm looking at here. The 3 criteria I use to help me find the technicals, I look for a lower percent BB20, so it's down at the bottom of its Bollinger Band. I want it to be below the SMA 20. A lot of times I won't use this under 1 day, but I will look for stocks that have just had a MACD crossover within 2 days or more. Sometimes if I'm looking for a recent crossover, I'll reverse it, where I'll look for the MACD crossover to be in the last 2 days. Of course, when I'm looking for bullish, I use the MACD above. Oh, Biogen. Yeah. Okay, so this one just, had a recent pop down in price. And there you go. So it had an upper Bollinger Band, and then it just went the opposite way. So here's one that's been showing a lot of weakness right after a big gap. This was probably the earnings, and now it's coming down. It's below the SMA 20, hitting the bottom band, just crossed over the MACD. It's an interesting one. Interesting one to consider. Okay, not a recommendation or suggestion as always, but there we go. All right. Okay. Isaac has a comment about the RPM techniques, the married put techniques, and he says the married put strategy seems to tie up money for too long and carries an additional risk of buying a long-dated put. Well, yeah, it's the idea of the strategy discussed in the blueprint. I don't want to use a 1 month out put because I'd have a higher annualized cost of insurance if I'm buying month by month. That's one of the 3 core principles of trading. Additional risk of buying long dated, yeah, you're paying into time, but you're not going to hold it for all 6 to 8 months if you follow the technique and you follow the rules in the blueprint. This will work only if the stock moves up a lot. No, I've got double-digit % gains on stocks that have fallen. I've got returns where the stock's moved up 1%, and I've got 5 to 8% gains. If you follow the rules and use the income methods, you can outperform it. Okay, yes, you can turn losers into winners with this technique. The one I should have had more on, of course, I'm going to take a loss on UBNT. I know I am. It's one of the Fusion trades that Fusion subscribers are tracking. The stock's down, I don't know, 45% from where I got it. I could have a 50% gain on it if I did something, if I did income method number 12 twice. I think I could have, no, it's not down 40, I'm sorry, it's down 35%, and I could have a 45% gain on it had I done income method number 12 twice. I didn't. I'm going to take a 7.5% loss unless something works out in the next 2 days where I could manage it and only take a 4% loss. Okay. Had I been doing a covered call, I'd still be down 31% on the position over the same time frame. You get a 30% loss, you need almost a 50% gain to get back to break even. I'm okay taking a 7% loss, needing an 8% gain to get back to break even. Okay. If you're betting on bullish direction, why not buy the stock? Because I have a stock that's down 45%. Okay, it doesn't mean I'm a bad stock picker. Something happened to that stock that could not be read in the charts. The first one wasn't because of earnings, okay, on UBNT, and that'll happen. And then you get in that slippery slope. Why not just buy the stock or ETF? Number one, if you buy ETFs, I'll probably still outperform you with married puts. Okay, this has been a long bull run for SPY. How long do you think that's going to continue, and are you going to see that every 6 months? No. ETF growth you should expect for SPY, IWM, QQQ, 3% per year on underlying price, max, maybe 4% on average if you've been trading it for 5 years straight. Sure, you've seen a large growth recently, but if you factor in all the other years and moving up and down, where will you be at? Okay. What is a good strategy to hedge this market? Gold is unpredictable and not reliable. I agree with you. That's why when I looked at it, I was saying that I would remove the ETFs because they could move triple fast and it could change on a dime. The best strategy is the married put. And I'm sorry, if you feel it ties it up too much, I'd look at maybe a collar. If you're determined that you feel the radioactive technique ties up money too much, but even as I showed earlier, if I got into that married put I showed today with the October put, I'm not holding it to October. I'm probably going to close out of it by July. Okay, we never hold the put all the way to expiration. I'm sorry, but when we're talking about a collar position, I didn't want to go into the search. A collar position is shorter term. If you feel the market is stagnant to unknown, you feel like you want to generate premium on a regular basis, but you want to have protection in place, you got to give up the upside. So if you have a stock that moves up 12%, you might only make 2. Well, sounds to me that the standard collar is your approach. Okay. So what is a standard structure of a standard collar? Let me go into collars, go into initial values, but I'm going to clean it up a little bit. I'm just going to make some subtle changes to this based on what I do. So I'm looking 10 to 55 days out in time to make sure I'm at least getting good premium. Risk, percentage risk, no more than 5%. Okay, I'll go 5.5. That's usually common for what I look at. Max return greater than 2.4 on the position. There we go. And I'm going 10 to 55 days out in time with some other criteria. Okay. All right. And now I'm going to limit one more thing. I'm sorry. The range out of the money on the call, I don't want it to be more than 3% out of the money. I'll still see Alibaba in there, I bet, but here we go. Okay. So what's a standard call? Let me look at the profit and loss chart. Here you're going to buy stock. So I buy Alibaba at 116. I'm going to sell an at the money 119 call for 165. I'd probably do a different structure here. And at the same time, buying the same expiration 112 put for 126. So I'm only getting about 40 cents of positive premium. But if the stock moves up, I'll make 2.9%. And if I'm wrong and it falls below 112, I'll make 3.2%. Okay? So how would I change this? I would structure it differently, but we're short on time here. So let's go to May 19th, 14 days out. Sell the at the money. Yeah, let's go the 118 for a little bit more than $2 and the 111 for 1. Okay? So we're going to sell this for a little bit more than 203. I'm going to buy this 111 for 1. It didn't show up in my results, but okay, so here, if the stock moves up above 118 from where it is now at 116 in 14 days, I'll make 2.6% for a 14-day trade. And if I'm wrong and the stock falls, I'll get 3.5% gain. My standard callers that I'm trading with about 20% of my portfolio have usually about a return on average of 2.8% if assigned, with a loss of around 3.7. Close to this, but not quite. I think that's what my average is 2.8 and 3.7. Okay? I still trade this in my account. I typically try to go at the money, and I look for this kind of structure with a 14-day trade. If I'm going a month out, 30 days out, I'm looking for a percent if assigned of about 3.1 with a maximum loss of around 4.6 or 4.7. You say, why don't you structure it better so you only have a 1-to-1 risk-reward ratio? Because the only way to do that is to have a put that costs more at about 115 and selling the 117 or 18. So you enter a debit collar where you have a lower probability of getting the return and a higher probability of getting the max loss. Okay? The structure of the trade, what's logical, what's likely versus what fits. I want you to pay attention to this. Okay? I still have a low risk just like I do in the married puts, and it's only a 14-day trade. That's great. But I have a capped gain. So if the stock does move up 6% in the first 14 or 20 days, as I'd expect when I open a married put, which by the way I'm right 65% of the time on with my radioactive trades in that scenario, in the first 20 to 30 days, I only get 2.8. To roll this, I'd have to add 3% in, which would increase my cost basis to 6.7%. Okay? But these numbers, 2.8 max return, 3.7% risk. Let's go back to radioactive trading. There's a tool there, which I'm sure you've seen, Isaac. Okay? Let me go back one. There we go. Return to radioactive trading. My apologies, folks. And it's called the Resources tab and the Trade Simulator tool. Okay? So let me take those numbers I just showed you for standard collar approach. Let's say I have an account of $15,000, and I'm going to invest 33% of that into a standard collar. Okay, so 1 month I trade $5,000 into each of those trades. I have 3 trades open for that 14-day period. My target return, 2.7%. My loss is 3.8%. Okay, now with a 50-50 win-loss ratio, let me get one. Okay, now this is close because I can still, because it's really close, if I have a 50-50 win-loss ratio, we can make money, but we have to be right more often than we're wrong. Okay, and this one even showed that if we were wrong more often, it looked like it was 49. Yeah, 46 here. Oh no, I'm still losing money. I started out with 15,000. I'm sorry, I'm still losing money. So I'm sorry, read that wrong. I thought I started with 10,000. Take it back. I get 56 4 times off the bat. Okay, so here I'm not profitable with this ratio. Okay, why? I need to be right. So my probability of loss I'm going to set at 38. All right, so here, 73% winners. Now that's a little bit much. There. Even if I'm right with this ratio 63% of the time, my ending amount after 100 trades, random win and losses, is only a gain of $1,400 from where I started. It's being right 63% of the time. 65%, up 2,000. 2,100. Not a bad ratio, okay? But this is what I know I have to see in my standard collar. That 20 to 25% of my portfolio, I'm still trading with standard collars, and I have been since about 2003 because I enjoyed the strategy. Still offers me limited risk, but you have to be right because the market's set that the trades that make sense, you're going to be risking more than you win, and you need to win 65% of the time, 67% of the time to be able to profit long term. Thankfully, I've been able to do that with this strategy. Otherwise, I wouldn't be trading it. If I'm successful with it, why am I only trading it with 25? Because my married puts are much more successful long term than the standard collars. And both of them have outperformed covered calls that I've traded for years, cash secured naked puts, bear calls, bull puts. I still use some of those strategies in my account from time to time, especially calendar spreads. I use bear calls and bull puts on the broad-based indexes, but long term, the credit spread specifically, one loss wipes out 10 previous trades. You can find yourself behind the 8 ball very quickly. Why isn't just buying a call the same thing? Because when you buy a call, instead of a married put, remember you're risking 100% of whatever you invested into the position, and you run the risk of overtrading. Okay? So, why am I bringing all this up? Let's go to the track record. I told you what my collars are usually like, right? That gain of around, we looked at the example of 2.8 to 3.7, talked about how that was. Here, now I'm right about 58% of the time, but my average gain on the winners is 7.1% because I don't have a capped gain or where I have to dump more money in to roll the call if I want higher upside, which reduces it. And at the same time, it's a 5.1%. Okay? And so in this, and I'm sorry, I see another point that was brought in, and I'll mention that to Isaac. Thank you, Todd. I just saw it there. So I'm right 58% of the time, 7.1% on winners, 5.1% on losers. Is that relevant at all? Let's go back. And let's go back to the trade simulator. And again, this time, let's say I'm actually trading with, I'll keep it at 15,000, and let's say I put 33% or 5,000 into each trade. Make 7.1% when I'm right. I lose 5.1% when I'm wrong. Okay. 56% winners. Random trading, it's up $11,000. Okay, in the simulation. I'm wrong more often than right in this simulation. 48 times. 48 winners versus 52 losers. I still gain $3,000. Why I'm pointing this out is even though standard collars offer the lower risk and give you the opportunity to generate income month by month, and you can get close to sort of a one-to-one risk-reward ratio, the married put technique, leaving the upside open and still controlling risk, is the only strategy I know where when structured properly, done correctly, you can be wrong more often than right and still make money. That's not the goal. There you go, 58.42, starting basis of $15,000, over 100 trades, of course. That's what this is looking at. Wins and losers, flip a coin 100 times. Heads you win, tails you lose. Almost double. All right? So that's what we're looking to accomplish here, and this is a simulation, I know. But if I'm able to keep this ratio over time, this is what I'm expecting. And this is what I've never seen in any other strategy based on the risks that are available and more. Todd, thank you. He brings up a point here for everyone, for Isaac. There are some brokers that look at the married put as an insurance trade and don't require the full amount or near the same margin. Interactive Brokers is one of them. Yes, it's called portfolio insurance or portfolio margin in some cases, Todd. That's right. So that structure I talked about on the married put we looked at earlier, I'm sorry, here on MM, the profit and loss chart, they know that I've, essentially got a cost basis of $2,286 per share, but the most I can lose in the worst case scenario is only $786. Well, I can use this to my advantage. Now, they're not going to just say, oh, put up 786 and you're fine, but they're going to allow me to do margin on this because they know, even in the worst case scenario, I can't lose more than $786. That's a guarantee. This is not a trailing stop that can get violated or a stop order that can get violated. I am guaranteed not to lose more than 786. So, Isaac, I understand your concerns. Some people, and even a gentleman that used to work with us and trade this account, sometimes refer to it as watching the grass grow. It's not for everyone. There are multiple reasons why this strategy applies to me. I tried trading credit spreads on a regular basis and making weekly credit spreads work for me. I know the risks of it. I knew the risks going in. I made sure that each credit spread I opened didn't risk more than 4%, 3% of my total portfolio value. But remember, this is what I do during the day. Teaching other webinars, coaching sessions, writing articles, working on products for different strategies that are going to be promoted on PowerOptions and things of that nature. Coaching sessions, working with you guys and things of that nature. Just random phone calls, answering emails. This is what I do. I did not have the time to even dedicate to doing a monthly credit spread portfolio. Okay? I just didn't. And I got more losses because I couldn't watch it close enough. Collars and married puts satisfy my need that is my day job. I'm not trying to make 10 trades a week. I'm not trying to make 5 adjustments a week. Okay? I have 6 or 7 positions open in married puts at a time, maybe 5 or 6 positions open. I expect to only adjust 1 or 2 of them a week at most. It is slower. But at the same time, I've saved myself from over-trading. I saved myself from over-leveraging. And I saved myself from trading against myself by trying to think I need to adjust the covered call here, then move it there. Oh, it just went above my call strike. I got to roll it up. Oops, it pulled back 2%. I've got to roll it back down. Oh, no, it just gapped up 6%. I'm actually behind the 8 ball, so I've got to roll it up and out 2 months. I don't need that. I just don't. Oh, Donald, great question. How closely to watch married puts? Depending on what day of the week it is, because I typically host webinars on Tuesday, Wednesday, Thursday, and Friday, but Friday at the end of market, thankfully, with you. I share my time here with you guys from 4:30 to 5:30 p.m. Eastern Time. But Donald, what I typically do is I'll go into the office, I'll answer the emails from overnight, maybe look at the futures, maybe look at some news, but not really, don't pay much attention to that. And then at around 9:40, I go right into my portfolio. And I pause the screen real quick. Let me do something real quick. So let me just run through this. At 9:40, I go ahead and I look at my portfolio on PowerOptions. I look at my married put portfolio first. I separate them by strategy personally. It makes it easier for me. But I'll go into my married put portfolio, and I'll take a look at the trades and where the stock prices are. Okay, I'm going to do something real quick for you guys. Okay. All right. There we go. Oh, wow, look at that. Sorry. Okay, so this is short-term straddles. Oh, sorry, short-term earnings straddles. There we go. All right. Okay, so what I'll do is I'll look in here, and I know my positions very well, but in addition to that, what I'm looking at here is where is the current price as my target and knowing where my put is. Now, I had other positions open on eBay that expired today, an income method number 6 and an additional put. Mondelez, I know where this is and I know where I want it to be. Ubiquity, this thing is the disaster that's down actually more than 23% from where I got in, and I'd actually have a 35% gain on this one had I done 12 twice. AEIS, okay, I know where the stock is now. It's at 74.45, but I know I've got a 75 call, and I've got alerts set. Okay, so I know that if the stock hits 75.80, it's going to warn me. I have alerts set on each of these positions. That's another feature. So I look to see what my alerts are and what they're not. Okay, if no alerts are triggered, I'm not really worried about rolling anything or adjusting anything right now. But I know where things are. I got a 20 call on Ally. The stock's at 1971. I'm actually hoping this gets assigned. I'm going to get out of the position. Simple as that. Other plans here as well, okay, for different structures and the different trades. And, I'll probably open 2 or 3 new ones. So I watch it 9:45 to 9:15. I quickly check to see if there's any alerts. I'd also get an email. And then I look at where my prices are, where my positions, and if I see something that looks out of whack. Did one of the puts jump up or jump down too much overnight for some reason? Okay, I won't see it. Now, I'll check my other portfolios too, and then I'll go into, if I want to open a new position, I'll go to married put and I'll go to search and I'll look at what's available and what I have left for the money I've allocated to RadioActive Trading, the 6 positions I have open, which one matches what I'm looking for here as far as cost basis and what I want to invest in the position. Okay, and then I'll apply the second tier to that as well. Okay, all right, so today I check it, I get in and check it at 9:45. Now I might have a coaching session at 10 o'clock, send out an email 5 minutes before 10 for a 12 o'clock webinar on Tuesday. maybe check after my first coaching session, see what's going on at 10:45 before the 11 o'clock session, and then jump into the webinar there. Do the webinar, check the webinar, check my trades again just in the portfolio, see if anything was triggered, and go to lunch and come back. And probably won't check it again until 3 o'clock. But each of these times, I'm only checking about 15 minutes. And most of the time, because I've set the alerts and I have the emails, the email triggers in my portfolio set to email me if an alert's triggered, I don't feel the need to check it unless I know something's happened. If I log on at 9:32 to take a look at it and I see SPY had dropped 4%, I'm going to go right into the Mary Put portfolio, see where I'm at, and then check my other trades too. On average, I'd say no more than 2.5 hours a week. I spend roughly 20 hours a week talking about radioactive trading and writing articles and products and other things, but in general, I'd say about 2 to 2.5 hours max a week on my radioactive trading positions. Some weeks it's much less than that. If I'm not in earnings season, I'd say it's almost lowered to about an hour and a half. Once or twice a day for the 5 days for probably no more than 10, 15 minutes, 20 minutes at a time. That's how much time I spend. It's a time saver for me. I don't need to worry about watching it on a constant basis as well. Okay, so that's about how much time I spent. All right. Well, Sam, I'm sorry I didn't get to your notes here. It was below everything else, but Sam was playing some Tesla calls. It closed at 306. So he made some money there with a 50-cent delta that he got into. Sam had also commented that when we were talking earlier about the, 3 a.m. is at an all-time high today. Sam feels you should sell the puts potentially, or make it a bull put there. And he just wanted, Sam, I'm sorry, didn't see these until the end. They were off the bottom. Sam also reminded everyone that, when we're talking about covered calls, and I had it with the married put portfolio, and we were discussing the covered call trade. Remember, and this is my opinion too, this is Sam's opinion and this is mine, covered calls are really a bearish strategy. When I enter a covered call, yes, you might want to get assigned and just roll the money over time, but in general, it's more of a neutral to slightly bearish position. The best case scenario is for the stock to be just below your short call strike so it expires and you don't have to do any adjustments, and then you just keep selling it month by month or week by week. It's almost very neutral. Or you got to be out of the money far enough to where the stock won't reach it. So whenever you sell that call, what you're really saying is, I'm hoping, or I'm analyzed it, and I don't think the stock is going to be trading at or above that strike price in the next 30 days. Unless all you're doing is weeklies where you're hoping to get assigned, make that 0.8 or 0.9% per trade, and then continue just to roll into new positions, new positions, and new positions. I think Sam was referring to this in relation to the question, I'm sorry, this was in relation to the historical question on SPY and how to track covered calls. That's why Sam had mentioned that. And, he was talking about doing puts, doing September puts on one contract since SPY is at a high to protect the stocks. He has it to 11. And then he'll buy more puts if he needs to at that point as well. Bought the puts, I'm sorry. So that's what Sam is considering because it's an all-time high. And I think it wasn't Donald, it was David, but the investor who asked about tracking the SPY covered calls. I'm wondering, I think they're trying to see if by selling covered calls on a weekly or monthly basis on the run up and even with the divots in the last, at the beginning of the year when we had that drop down in January and then that hiccup again in February of last year, January, February of last year, would he have outperformed holding SPY and doing nothing by doing covered calls? I don't think so, because when the dips factored in, he still would have taken at least 90 to 95%, 95 to 97% of the loss on the dips in that time if you're just closing out and rolling into new positions or just rolling the call, and you would have capped the gain to the upside continuously without putting more money in to roll the position. I say covered calls in with the divots from the last year, last 15 months, and then moving up, I'd say you would have done worse trading covered calls continuously on SPY on a weekly to monthly basis than just owning it outright. I don't know though. Maybe you did perform a little bit better, but I don't expect it to be much because you would miss some of the upside without putting more money into the position. So it wouldn't have given you as much advantage of generating, let's say, 1.5% per month. It would have been lessened by some of the times you had to roll the call for a debit to get any kind of premium unless you rolled out 5 months out in time. So it may be questionable, but I agree with Sam in the sense that it's a neutral to slightly bearish position because the best case scenario is the stock to be just below your short call strike so it expires. you don't have to pay any premium or commission to buy it back or to roll it, and then you still hold the stock and you can just sell it again and expire, sell it again and expire, but you're just having the stock right here slightly below it. Kind of really neutral. All right. Well, ladies and gentlemen, I think that's all the questions that we had for today. I don't see any others coming in. I want to thank you all for joining me. I did record today's presentation. It's about an hour and a half once again. We did that last week too. We covered a lot of good information. We covered a lot of great information this week as well. So there's absolutely nothing wrong with that. I just want to remind those of you here, if you haven't done so yet, remember you can go to PowerOp.com at any time. Just put in your first name, last name, and email address, and you'll get a 14-day free trial to Power Options to test all the tools. Even the back testing tool we showed today, you'll have access to that with 3 months worth of data to do some back testing on your strategies. We have different levels of service. There is an end of day, which is only $40 per month. It doesn't give you access to some of the other features. Most popular is the 20-minute delayed service at $60 per month. You can upgrade to the historical, which will give you that historical data on top of the 20-minute delayed back to April 2006 for only $100 per month. And we do offer a real-time service and real-time with historical data as well. And remember, for other free stuff, check out our blog at any time, blog.powerop.com. I posted one this week that was related to the special dividend on Costco and how there's no such thing as free money, with the special dividend coming up on May 8th with the $7 dividend on Costco. I had a lot of questions about investors trying to buy calls and buy puts to take advantage of the movement down. Well, it's not what you think it is. Remember, you can check out our webinars at any time, powerop.com/webinars.asp, and you can go to YouTube and look us up at Power Options as well. Other than that, again, we spent the first half hour talking about radioactive trading, the setup, when and how to use the income methods. If you're serious about limiting risk and following the rules correctly and seeing what the rules that apply there, go to radioactivetrading.com and click on the store there. Check out the blueprint to get the 5 special bonuses we're running right now. But of course, as always, if you have any other questions, you send me an email anytime. Just send it to support@powerop.com. You can also get me at support@radioactivetrading.com. And also, you can call us during market hours at 302-992-7971. And those of you that are trial members or subscribers, remember, you can schedule a coaching session. We just talked about those a little bit ago. So you can schedule them during the day. Usually have a 10 o'clock and 11 o'clock coaching session with trial member or subscriber on most days, and then a 12 o'clock webinar on, in addition to that, on Tuesday, Wednesday, Thursday as well. So you can schedule those at any time. And if I'm not available, you'll get Ernie as well. Ladies and gentlemen, thank you for joining me today. I hope you all have a great week. Sam, I'm glad you enjoyed today's presentation. And he said he thought it was very good. He loved today's session. Thank you, Sam, and I hope you have a great weekend as well. We'll see everyone next week as we go into the 12th of May expiration with our investments. See what new earnings are going to come up next week and help us or hurt us there, or see what the market does to us. Thank you again for your questions. It was very great. I'll get the recording posted. I'll send you an email when it's posted, and you can view it later. And again, take care, everyone. Good night.